Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us how the markets reacted to the Canadian federal budget on Tuesday. Apparently, the loonie wasn't all that happy. Author of the second edition of When the Bubble Burst Surviving the Canadian Real Estate Crash, Hilliard MacBeth, believes budget measures designed to help new home buyers won't have much of an impact in Canada's major markets. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, says California is in a housing slump and most of the U.S. is following that trend. He'll tell us just how bad it is. Plus, right after the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to This Week in Money.
Good to be with you once again, Jim.
Ross, how did the markets end up the week? We had some sizable gains to start off. How did it end?
Yeah, well, we started off the middle of the week. Markets were up very, very well. And the Fed came out on Tuesday and sounded, nice and dovish. They're no longer looking for an interest rate hike this year. They're talking maybe one next year. So, you'd think that was good for the economy. But, the reason we're not getting higher rates is because the economy, whether it's here or Europe or over in China, it's slowing down, and invariably, when you're getting lower rates, it's indicative of just that. I mean, clearly, best bull markets in history happened during a rising rate structure, not a declining one. So, it was a rough week to finish off the tail end of the week here. Not an outside reversal, but S&P, the Dow, both down pretty big on Friday. The other thing that's showing up is that the transports continue to underperform, and anytime that you're seeing that one, you can expect that it's got implications. So I think whether it's the next few months or whether it's the next year, the fact is that we are on the verge of maybe not a recession, but at least a slowing economy, and therefore probably looking for equity markets that don't have a lot of upside left in them. And at this point, you look at the seasonality. April is usually the last of the really good months in the 6-month stretch. So maybe there's a little bit left, but not too much from what we see. And if you look at where they'll usually need the leadership, you want to see it over in the banks. And with the yield curve the way it has now inverted on the front end, the fact is that the banks have not got those premiums that they can lend out at. So if you look at the regional index, like the KRE index of regional banks, or you look at the XLF, the broad based ones from New York, you see that they've had a pretty rough stretch here. We're talking about on the KRE, this was up at 57 on the index just 3 weeks ago, closing off the week at 49. So percentage-wise, I mean, that's a pretty big hit for a bank group. And invariably, that has been a poor omen as far as the equity markets are concerned.
What's happening with gold?
Gold ended up with probably a better performance relative to silver and platinum during the week. Got up into the 13.10, 13.15 range. There's been a little bit stronger here coming off the bottom of 2 weeks ago than we thought it would be. We thought we'd see a sort of 13.06, 13.08 for the first resistance level. It's trying to push through a little bit better than that. I think you really need to see it get, through that major resistance up in the 1350-ish, 1360 to say that it's breaking out. For now, the lower interest rates help out the gold market. It's not having to compete against equities in terms of giving a chance for an opportunity to make some money in the market. So at this point, support is still probably around 1,300 to 1,295. If that gives way, I think you're looking at the 1,265 as the important level for there.
Was there any reaction to the Canadian federal budget on Tuesday in the markets?
Yeah, well, the Canadian dollar is it's just not doing well. You take a look at it. A couple of weeks ago, I guess a month ago now, the last decent rally in commodities and in the oil market, the Canadian dollar underperformed. And we take a look at what would happen this week. You got another significant divergence here. The dollar into the early part of the week had a little bit of an uptick. It was more because it was just oversold. So it rallied about a cent off the lows from early in March. But by the end of the week, it's given it all back. And so we take a look at the fact that all it got was a bounce of, after a 2-cent decline, it made back 1 cent of the move on its bounce. Whereas the oil market was up to $60. And without any confirmation on it with the Canadian dollar moving with the oil market, we know that the clearest move for the dollar here is to the downside. And don't see that the Bank of Canada has got a lot that they can do in terms of interest rates to help attract money in here. The deficit numbers are just once again looking terrible. The Bank of Canada and the government have been so off as far as their projections for the economy. They at this point still think they can get around to balancing down the road, but they without the GDP growth, the spending that they're doing is just not looked at favorably. You take a look at somebody like Fitch, they're out with a debt warning as far as Canada's concerned. So easiest path here appears to be under 70 cents for the Canadian dollar.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Hilliard MacBeth next on This Week in Money.
Always consult your investment professional before making any investment decision.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Hilliard MacBeth, author of the second version of When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Hilliard, welcome back to the show. We have a new federal budget. They've made some moves that they believe could help first-time buyers get into the market. Why are they doing something that could heat the market up again?
Well, I think they need to be seen to be doing something, and it's pretty. I mean, the worries before the budget came out were for something much more significant, and for instance, extending the maximum amortization to 30 years from 25 years, which would, improve the ability of a lot of people to buy housing. And there was even some other rumors about things that they might do, pretty significant things. So getting rid of the stress test, for example, where they apply a higher interest rate of 2% to everybody's calculation to see if they can afford it. But none of those things happened. The only thing they did was really pretty minor in its impact. The details aren't finalized yet, and there's some questions called a shared equity mortgage up to 5% or 10% of the purchase, depending on whether they're buying a used home or a new home, for first-time buyers only. So quite restricted. And then they put a maximum income on the couple that's buying the home, and a maximum 4 times income for the size of the purchase. So with all of those restrictions, it's likely that it'll go the way of the BC home buyers plan, which I was just reading about this morning, has been canceled, but you'll recall it was announced a couple of years ago, and only 3,000 people in the end actually bothered to apply for it.
And it probably costs the provincial treasury a lot of money just to administer.
Yeah, now this new thing, actually, it's interesting. At the first go-around, I missed this federal plan, but it actually, there's a little wrinkle in it. They said they want third-party people to participate, so it definitely is an equity wrinkle, which means that if you have equity, of course, then if the house price goes down, you share in the losses. If the house price goes up, you share in the gains. And there's a couple of private companies out there that apparently do this. I only heard about this just in the last month or two. And so the federal government actually wants them to take the lead on this, and then the CMHC somehow would get involved by providing some money. They're talking about $1.25 billion over a number of years, so it's pretty small. To give you some idea, there's about 5% of all the housing in Canada turns over in a year, and there's about 9 million owned properties. So say 500,000 roughly. And first-time buyers are about 20% of that, I think, about 100,000. So it's a pretty small pool. And then, of course, many of them probably will just go ahead and not bother with this deal. But there's some entrepreneurial companies that were promoting this idea of they would put some of the money in and share in the gains or the losses. But it just sounds very complicated to me.
Why would they continue the stress test when it's become pretty clear right now that the U.S. Fed doesn't plan to hike rates for the rest of the year? I doubt the Bank of Canada would buck that trend. Why do they need to keep it?
Well, I think what happened was the requirements for qualifying. You don't have to go back that far, and the requirements were much tighter. If you go back 15, 20 years, 25 years, they didn't count both incomes fully. They counted at one point they only counted one income, then they started counting half of the second income. And that was to reflect the possibility of maternity leave or somebody losing their job or whatever. There was some wisdom in it. And so over the years, as house prices rose, a lot of those original restrictions, let's call them, or restraints, maybe you could say, kind of melted away. And the banks, I think, took the lead. The lenders took the lead and said, you know what, we haven't had any losses for a long time. We can reach out a little bit, to the point where up until recently they were, willing to lend almost 7, 8, 9 times their couples' incomes, which was never the case, 20, 25 years ago. So this stress test is just a way of trying to get some sanity back into the thing. And with interest rates this low, it shouldn't really be much of an impact, I don't think. Although the mortgage brokers, they have a industry association, a lobbying group, and they were claiming that it had hit things pretty hard. But it could also be just that the prices have started falling, and as soon as prices start falling, or not right away, but after a while, people notice it and they start to get less enthusiastic about signing up for all that debt. If you're signing up for all that debt and prices are rising, that's one thing. But if prices are falling, well, that's a completely different thing.
When prices are falling, are banks reluctant to lend money for a mortgage because if they have to foreclose, the house might be worth less than what they lent the money out for?
Yeah, I think banks are very slow to pick up on it. I mean, they see they've got their formulas, and it used to be not that long ago, maybe 20, 30 years ago, the local branch manager of the bank had a lot of say in whether they approve a loan. He'd look at the couple and he'd know their situation, maybe knows their family or something. Well, those days are long gone, and now it's all just a formula. It goes to head office. They punch the numbers into a computer, and if it passes, it passes. They don't even actually look at the home the couple is buying. They just have a program that just checks neighborhoods and say, okay, 600,000 in that particular neighborhood. Yeah, that's about right. That's about the mid-range of what houses sell for in that neighborhood. And so then it gets approved. And so it's become very mechanical. So I don't know that the banks right away would pick up, but after a while, if they start seeing losses, for example, or if they if the appraisals start coming in below what this would be the first hint, would be people offer to buy a house for 600,000 and the appraisal comes in at 540. Well, now there's a problem, and then the bank might start noticing that a lot of these fall through. In fact, talking to some realtors recently, they both mentioned independently that's the same thing, that these deals seem to be falling through at the last minute, which I suspect is appraisals. Now, they both were realtors that specialize more in the more expensive homes, but and on the more expensive homes, the banks will get appraisals. But I think they'll be they're not at the leading edge usually. Their loan losses have been so low for so long that I think there's a large amount of complacency in the mortgage approval departments of the major banks. But that'll change, and it'll change when house prices are down 15 or 20%. And in some cases in Vancouver and suburbs of Toronto, they already are down by that much or more. And then they'll tighten up. And when they start tightening up, then they just make a situation where things are drifting lower into more of a plunge kind of situation. And that's what happened in the U.S. And the U.S. still hasn't recovered. The U.S. the market bottomed in 2012, so now we're 7 years later. The banks still are not very enthusiastic about making mortgage loans 7 years later. So it takes a long time. Once they shift to caution, it takes a long time for them to go back to normal again.
Hilliard, I think you mentioned in one of our past interviews, Alberta's got something like 5,000 or 6,000 new homes sitting there. Could this plan where CMHC would kick in 10% for the down payment, could that help alleviate that problem?
Yeah, I think that's pretty much the only segment of society that's helped by this program. People that are sitting, the developers that are sitting with this unsold inventory, and it's quite large. A total of 5,000 in Alberta, 2,000 in Calgary, over 1,000 in Edmonton, and then the rest are sprinkled all over the smaller cities. And of course, the thing with builders, if they build 100 homes, all of their profit is in the last 10 homes that they sell. So if they sell 90 homes and 10 homes are sitting, they're still, in a desperate situation, because they've got to sell those last 10 homes to pay back their finish paying off their debt and then finally get into a profit margin. So, obviously there's a lot of builders, probably all over Canada, that are sitting with unsold inventory that, means they're getting very desperate. And, I heard about some in Vancouver and other parts, offering very, creative incentives to get people to buy. But this program, they're talking about, 5% for the existing homes, but 10% for the, so 10% kind of interest-free loan for the, if you buy a new home. So that's going to help with the new home builders. But unfortunately, with the cap of it works out to about 480,000 is the max. It's not going to help any new home, sellers in, Vancouver or Toronto that I'm aware of. There are a lot in Alberta though that will be helped, because there's lots of products sitting on the outskirts of Calgary and Edmonton that can be bought for 400,000 or maybe less. So that's probably where the program might actually make an impact. But it's not really helping the first time buyer. It's really helping that developer that's sitting with inventory that can't be sold.
We'll have more with Hilliard MacBeth when This Week in Money returns.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, Fitch credit rating agency says Canada's huge deficit and no plans to end deficit financing in the near future could threaten the country's AAA credit rating. What would that do to everybody else trying to get a loan?
Well, it could have a big impact, and there's some angles to this that people aren't aware of, and I wrote about it in the second edition of When the Bubble Burst. The magical thing in Canada, which is unique in the world as far as I could find, is that if the loan is insured, either through CMHC or one of the other two private insurers, the bank can basically make an unlimited number of loans because there's no risk weighting on that loan. So in other words, they don't have to adjust the amount of capital that they raise to support that loan because there's zero risk weight. Now that's zero risk weight in the international bank regulatory standards because it's guaranteed by a government which has a very high credit rating, AAA credit rating. So if that credit rating gets lost, well, first of all, just one intermediate thing before I get to that. I'm not sure that it makes any sense for that to be zero risk weight anyway, because even if the government has a AAA credit rating, and even if it's insured by CMHC, a private insurer, there's probably going to be 5 or 10% of those loans that are rejected by the insurer. Everybody knows how insurance works. The insurance company tries to not pay the claim by rejecting the claim if anything's wrong with paperwork or anything. And undoubtedly, in a real estate boom like we've had the last 10 years, there's going to be a few loans that where the documentation isn't that great, and the insurer is going to refuse. So the bank would be on the hook for those loans. But on top of that, the idea that just because the government has a AAA credit rating means that it's totally safe doesn't make sense. All they've done is shifted the risk of these very high risk loans into the taxpayers category, but it doesn't mean there isn't risk, because what if the government gets into trouble? What if the government can't support? I mean, at the moment, it doesn't look like it's possible that the government would run out of money to backstop CMHC to pay this insurance, but you never know. So there should be some risk weighting on all of these loans. So there's not at the moment. If the government loses the AAA credit rating, I'm sure people will look at that and say, well, then in that case, there should be some risk weighting. And that means that the banks can't make as many loans, or if they do make the same number of loans, they have to start raising capital. And there's only two ways they can raise capital. One is to not pay the profits out in dividends, but keep them in the company in the form of retained earnings, so that becomes capital. Or secondly, they can sell shares on the market, on the stock market, and issue new shares. Well, neither of those alternatives, the banks would hate to do either one of those alternatives. They're very proud of the fact they've never cut their dividends since 1860 or something. And even in the Great Depression, they never cut their dividends. And secondly, nobody wants to issue shares on the market, especially given the bank's shares the last year or so have been kind of sagging a little bit in the market. So that would just dilute the value on the stock market. So it's interesting. The whole thing is kind of backstopped by this idea that because the government is involved and the government's got a AAA credit rating, that everything's fine, and there's no subprime lending in Canada. But in the reality, some of it is definitely subprime lending, and the government backstop in most cases would be solid, but you never know. Now, I don't think they're going to cut the AAA credit rating right away. I think it almost seems like it was almost a political thing to bring that out right at the time of the budget. But the trend is definitely away from the AAA credit. There's only one other large OECD country left with a AAA credit rating, and that's Germany. And Canada's the second largest behind Germany. And then there's a bunch of smaller ones that have it, but UK, France, Spain, US, they've all those other ones have lost their AAA credit rating. So, and Canada isn't in terrible shape. It's just comparable to France and the US. So the ratings agency saying is, why does Canada have it when it's got comparable numbers to the US and France, and both of those countries don't have it anymore?
Well, the government brags that out of the G7, Canada has the lowest debt to GDP ratio, so everything's going fine. Should we be comparing ourselves to others or truly look after our own financial house?
Yeah, well, the comparison actually does flatter Canada quite a bit because the federal government is only 30% of GDP. And technically, the provinces are separate legal entities. But when you count the provincial debt, say especially Quebec, Ontario, and even Alberta now has quite a bit of debt. Not anywhere near 30% of GDP, obviously, but when you add it all up, Canada, if you add those in, Canada gets back up to 70-80% of GDP, which puts it right smack in the sort of the average of those kind of countries. So they're not saying that Canada is desperate or anything. Canada's just not as special as we think we are. Let's put it that way.
Yes, there's more to us than just beer and hockey.
Yeah.
We'll have more with Hilliard MacBeth right after we return.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, did you see anything in the federal budget that you think could boost the economy, or is this something just stay the way we are and hope the apple cart doesn't spill over between now and the October election?
You know, I didn't really see anything that would make a big difference. Obviously, the most important segment in Canada is the energy sector and the housing sector. Those are the two. And the energy sector is actually doing a little better right now. The oil, the Western Canada Select is up to $50 US, and the international price is $60, so it's only a $10 discount now. So that's much better than it was. If only they could get the oil out of Canada and ship it somewhere where they could get paid for it. But on the housing side, the real estate side, which has become a huge component of our economy, when you count in the lending part of it and the real estate commissions and the construction, employment, and all of the things, it gets up to a very high percentage, like 15% or something. Mortgage growth has slowed down to 2 or 3%. Well, there's just no way that our economy can can avoid stagnation or even a recession if mortgage growth is only 2 or 3%. That extra credit that going, that we were chugging along at 5, 6, 7% for years. That extra 2 or 3% above the rate of growth of GDP was what was giving the impulse, called the credit impulse, for the spending. It wasn't just housing; it was cars and furniture and all the associated stuff. And people felt good because their house was going up in price. They could borrow more money. They got a line of credit. They got credit cards. They got everything. But once that starts slowing down to the rate it's been now for several months, then the federal government would have had to do something quite extraordinary in the budget to counteract that. And I didn't see anything. There's nothing in there that is anywhere near the magnitude that would be required to counteract the ending of that credit impulse. So I think we're in for probably a recession in Canada if we're not in one already. If the U.S. is one bright spot for us because Canada exports a lot of stuff to the U.S. And the U.S. economy seems to be pretty strong, although the Federal Reserve came out with their announcement on Wednesday this week, and they were hiking rates, and they were getting rid of the massive quantitative easing balance sheet that they had, and they decided to end both of those programs. So they're no longer going to hike, and they're going to stop shrinking the Federal Reserve's balance sheet. So they obviously are worried about a recession in the U.S. There's no way that they would stop hiking rates at the current low level. Rates are still way below kind of like normal. Whatever normal is estimated to be, say, 3%, and rates are still well below that. They wouldn't pause. They wouldn't put this on pause now unless they thought that there was a possibility of a recession coming. So it's quite an extraordinary time in North America. In Europe, things are very slow, and the Brexit thing is not going to help. There's quite a lot of gloom over there. The good news over there, though, is stock prices are very cheap, so it's reflected in the stock market. Not unlike the U.S., where prices are extremely high, even though people are worried about a recession. So Canada could be in for a tough time for the next few months because of all of these factors. There's really nothing on the horizon that gives a big boost to the economy, and the election is 6 months away or something like that. So it doesn't look good for the incumbent government. Usually doesn't do very well when house prices are falling and the economy is in recession. And the chances of both of those things being true 6 months from now are pretty high.
Do you think the opposition doesn't have to do much? They just have to sit there and watch things fall apart?
Yeah. Yeah, it's like we have an election on in Alberta where I'm based, and the opposition, Jason Kenney, is in trouble because of campaign skullduggery a couple of years ago. So I don't even think that's going to derail. The dissatisfaction in Alberta is so high, and the polls indicate that people are very much wanting a change. And it would appear to be the same on the federal level as well. It's I haven't seen a study, and I haven't done any research myself, but it seems likely to me that very few governments get reelected when the economy is weak and people's houses are dropping in value. It's just like, there's nothing more important to people than kind of like getting ready for retirement and the economy and that when it comes to election time. And the house price seems to be a kind of like a key indicator of how well people are doing. It shouldn't really be. I mean, but it looms very large in people's. When people calculate up their balance sheet and how they're doing for getting ready for retirement, the house price is a big, big factor.
Right. If you sell it to help finance your retirement, you may not get the money you expected.
It's interesting. In 40 years of doing what I do as a financial advisor, I've actually seen very few people be able to successfully sell their house, take the money out, and use it to pay for retirement. And it's not that it's impossible. It can be done, but nobody wants to go backwards in terms of their living quarters. So what happens is they go to sell the older 2-story house that badly needs renovation because they stopped spending money on it 10 years ago, and they want to live in something kind of modern and shiny, brand new. So they go from 2,500 square feet to 1,500 square feet or less, but they end up paying the same amount of money. And so there's no money left over to help with retirement. It's quite amazing that, going to rent a place would obviously free up a lot of money. And but most people don't want to do that. I've seen some creative ideas. I saw something the other day about people going and living in a trailer and just traveling all over North America in the trailer and not having any home at all. That would probably save quite a bit of money, but I think a trailer might seem pretty small after a few weeks. You'd really have to have a great relationship in your marriage, right?
Well, I think a lot of people think of that motorhome as freedom because you don't have property taxes, you don't have hydro, but take a look at the price of gas.
Yeah, that's right. You'd have to have an electric motorhome with free recharging stations, which that probably isn't likely to happen either. So.
And how many solar panels would you have to put up every day?
Hey, I saw the new thing, fuel cells. So the fuel cells are not new, and I never thought they were going to. The Toyota's been working on them forever, and they just don't ever seem to work. But there was a story recently that said that the trick with fuel cells is not to have the fuel cell in the automobile, because then you got to carry the fuel around and you got to have all this heavy, this unit. What you do is you have an electric car, and the fuel cell is used to power the recharging station. And I thought, wow, that actually makes a lot of sense. So fuel cells, which I don't fully understand the technology, but I gather are more efficient, could be used to establish a bunch of recharging stations, and the cars could be electric, because electricity is very efficient for traveling, as long as you can recharge it, fairly frequently and not have it take too long to recharge. So the fuel cell might yet appear as a major factor in the whole thing.
Do you think auto sales might be down because people are waiting for affordable electric cars to show up to replace their current vehicle?
Well, I thought that was a possibility for a long time, and then just in the last week or two, several studies have come out and said exactly that auto sales are way down. Like BMW just reported on Wednesday this week that their sales are well below 2018 levels in early 2019, and 2018 wasn't a good year either. And they're embarking on a multi-billion-dollar cost-saving program. And without any doubt, I think that they mentioned in their press release that electric car there's not enough people buying electric cars yet to make a difference. But what if everybody who's thinking about buying an electric car goes on pause while they think about whether they should wait for the car or not, and they just hang on to their current automobile? I think that could cause a major slowdown in the worldwide auto sales. There's about 88 million annual sales in worldwide in cars, and almost all of that is internal combustion engine. So if even 10% of them think that maybe they'll wait for an electric car, 8 million cars, that'd be devastating to the automobile industry. Now, maybe some automobile manufacturers get hit harder than others, but that whole industry is not set up for a 10% reduction in sales, and that seems to be what's happening. The surveys show, there've been several surveys saying when they interview people, you thinking about buying a car, or what kind of car are you going to buy? They're more and more getting this answer. Well, I'm going to wait and see, if there's a good electric one coming out. So, and I read recently about Henry Ford in the 1920s when he switched over from, I'm going to get this wrong, either the Model A to the Model T or the Model T to the Model A. He had to shut down the assembly line for 6 months, and to switch over, and it caused a recession in the United States. That's how significant it was. But just that one thing alone of switching over the assembly line of the Ford Motor Company showed up in the economy as a recession. So that's what might be what we're looking at here, is a significant economic impact in the short run. And then in the longer run, there's some other aspects to it, which is that it takes fewer people to manufacture electric cars than it does to manufacture internal combustion engine cars, because the motors are so much simpler to make, so they don't need as many people. That's more likely to hit countries like Germany, but it could hit Canada and the United States as well.
Hilliard, you own an electric car. What's your experience been?
Been fantastic. I'm just on a little mini trip here to the ski hill, and I'm close to the town of Invermere in BC, and the town offices has a charger outside. There's no the nearest Tesla supercharger is 100 kilometers. There's two of them, and Invermere is exactly 100 kilometers away from both of them. So I went last night up from the ski hill into town, about a 20-minute drive, plugged into the thing there. There's already a car there. So there's only one plug-in. It was already occupied. So anyway, I came back, and so now I've got it plugged into a regular outlet, just a 110 volt outlet, and it's charging. That's the good news. The bad news is it's going to take probably to get a full charge. It probably takes several days. So it's charging at the rate of 6 kilometers per hour. So in 24 hours, whatever that is, 200, not even 200 kilometers. But that's all I need. I only need 100 kilometers to get to the supercharger. So the range anxiety thing is the biggest question I get when people ask about electric car. And it does take a little bit of thinking, as I've just described, in terms of how you're going to handle it. But other than that, everything else is super positive. And even the range, the charging thing is kind of like a little game that you very quickly. My wife also has one now. When the Model 3 came out, she got one of those, and she had worse range anxiety than practically anybody else I knew. If the old car with the gas tank gets below half, she wants to fill up, and she's having no trouble getting around with it. So it's that particular concern seems to be overblown. And of course there'll be more and more chargers. I'm kind of in this remote mountain spot where there's not as many chargers, but if you stay close to the main highways, there's a charger. They're not even 200 kilometers apart. They're 150 kilometers apart at the most. And my range is 500 kilometers. And almost all the new cars coming out are 500 kilometers or greater. So it's not a problem for road trips. And of course, in the cities, you don't travel far enough to ever. You only have to charge up about once every 2 or 3 days. So you can do that at home, or you can go to one of the superchargers in town and get a charge there. So. And apart from that, they're just lots of fun to drive.
Hilliard, thank you so much for being on This Week in Money.
Nice to talk to you again, Jim.
My guest has been Hilliard MacBeth, author of the second version of When the Bubble Burst, Surviving the Canadian Real Estate Crash. Coming up, Robert Campbell next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYVresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm speaking with Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. He's speaking to us from San Diego. Welcome back to the show, Robert.
Thank you very much, Jim. It's always fun to talk.
Bob, you have an upcoming seminar. Where is it, and can you tell us about it?
Yes, the date of the seminar is March 30th. It's at the La Jolla Marriott, and the title of it is How to Use Historically Reliable Indicators to Call the Next Real Estate Peak.
Have you updated your book, Timing the Real Estate Market?
No, I'm on the 4th edition. The 5th edition will be coming out soon, and that will be updated through 2018. And the reason I keep updating it is because the real estate timing model that I created still works just as effectively today as it did 20 years ago when I originally created it. And that's always nice to know from an investor standpoint, has this thing continued to work? And it has.
How does it help people understand what's going on?
Well, the first thing that you have to understand is that, practically all markets are cyclical, and real estate is one of those cyclical markets. And to be a superior a real estate investor isn't about buying a well-located piece of property at any time, or is it about cash flow? It's about buying a piece of real estate when prices are low, when risk is limited, and price appreciation is anticipated. That's what separates the really, really strong investors from those that do so-so or poorly.
With the spring real estate market being here, how are the housing markets in California and the rest of the U.S.?
Well, they're recovering a little bit right now, but the trend for California, the trend turned down in the early part of 2019, Jim. And San Francisco was the first California city to turn down, and my timing model, generated a sell signal for October of 2018. I just got a sell signal for San Diego in January of 2019, and essentially all the major cities in California should be sold. They're all going down. And interestingly, over the course of the last 40 years, San Diego has been a leading indicator to the California real estate cycle, and it's been 100%. And so that's when San Diego gave a sell signal, even though Los Angeles isn't quite there yet, Sacramento isn't quite there yet. The others, I'm telling everybody, just get out. I mean, there's way more evidence saying that the peak is behind us, and now we're on the completion of the cycle to the downside.
Mm-hmm. Is the U.S. in another housing bubble, and is it bigger than 2006 and 7?
No, I don't consider it to be a bubble, and the magnitude of the correction certainly should, all things equal, should not be as great as the last one, because the last one was indeed a bubble. This is just more of a it's going to be another cyclical correction to a boom market, which is, happens throughout history all the time. I think in the U.S., based on previous cycles and looking at historical patterns, I anticipate U.S. housing prices will probably go down somewhere in the range of, 15 to 20% from their peak. And California, I think they're going to go down between 30 and 35% from their peak before they reach a bottom where a new recovery will start.
When housing bubbles burst, how long does it usually take for the prices to go from peak to trough?
Interestingly, there's a lot of people talk about a 7-year cycle, and that may have worked in the past, and I suppose it has, but it certainly hasn't, been that accurate recently. For California, for example, going back through 1975, from the peak to trough has lasted 6 years, the last 2 cycles. So the California housing market peaked in 1990. It bottomed in 1996. It peaked in 2006. It bottomed in 2012, which is 6 years. This one's peaking in 2019, and I anticipate the next bottom, prices to bottom out in 2025, 6 years from this year.
We'll have more with Bob Campbell when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Robert Campbell. Bob, do you have any current buy signals for U.S. housing markets?
None. Zero.
Does it look like the Fed has room to move rates higher this year? Or are they pretty well stuck?
They're stuck. They freaked out when they started raising rates from 0.25% up to 2.25%. The U.S. stock market fell by 20%. Housing started going into a decline, so they chickened out. And now it looks like the next move isn't going to be a hike; it's going to be a decline. And particularly interesting today, which is March 22nd, the 3-month, 10-year Treasury market yield curve inverted, Jim. So it looks like, and I've seen others, we've been edging toward a recession anyway, and the odds of us hitting a recession with an inverted yield curve and housing on the decline is about 100%.
With the rumblings of a recession, will it be as bad as the crash of 2009, or just a big, serious correction?
I think I don't think anything's going to be as bad as that last correction, because, that it was housing that brought that down. Housing prices in California, for example, tripled off their bottom. That was the biggest price move ever, and U.S. prices did the same thing. And that's kind of what took the wheels off the car. This is going to be it's going to be a serious downturn, but I doubt very seriously that it'll be as bad as the last one. It'll seem like it's as bad, but it won't be.
Mike Shedlock has a theory that perhaps we won't, if there's a recession, we won't see the job losses we did last time because it was so hard to get those people signed up to work for your company in the first place. And maybe some companies will kind of bite the bullet and not let people go this time.
I think that's wishful thinking. I know Mike, and I respect Mike. That's an opinion, but there's nothing supporting that. During economic downturns, when revenue growth starts spiraling down, you have no choice, Jim, but to cut costs. And of course, the biggest cost you can cut is with employees. If the business isn't there, you aren't just going to let these employees sit around on their hands and do nothing. Interestingly, what Mike's talking about, as I think about it now, that's kind of the Japan model. Japan, what they do is they kind of stockpile money during the good times, because when the recessions hit, they're more of as much a family as they are a private enterprise that's focused on generating profit. That's something that would happen in Japan, but I doubt that'll happen in the United States.
Will there be the workforce available to come back from a recession if they get people laid off? If you're a laid off baby boomer, why not just retire?
Because the baby boomers can't retire, Jim. You go back to the year 2000, you look at job growth in the United States, and you think it's young kids. Not at all. It's people over 65 years old. They have to keep working. They don't have any choice. They have to keep working, because most people don't continue to work after the age of 65 if they don't love their job. And that's where all the growth has been, where you see these seniors working in Walmarts, in Rite Aid drugstores, and everywhere now. They have to work. And that'll continue to be the case. Nobody's going to retire. Jim, you and I both love what we do. And that's good. Because, even though, we could probably retire, comfortably, but, my feeling about things, if you love what you do, why would you ever want to retire? People ask me do I play golf? I'll be 72 in a month. And I just laugh and I go, I'm too young. And people that know me, they laugh too, and they go, that's a good answer.
Well, the head engineer at the radio station I used to work at, retired, and 3 months later he was back working like 3 days a week, and I said, what are you doing here? And he says, well, you can only golf so much.
Exactly.
And he loved what he did.
So freaking right. Or in my case, I could only go to the beach here, in San Diego for about 2 straight weeks. Then I'd be bored stiff.
We'll have more with Robert Campbell when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. I'm speaking with Robert Campbell. Bob, the stock market has come back from its December lows. What do you see ahead for the Dow and the S&P?
What I see ahead is going to surprise a lot of people. And I'm certainly not the expert on the stock market that I am with real estate, because I have a real estate timing model that just gives me a incredible edge as far as, what the markets are going to do. Somebody I follow that I trust a lot, I think that the next big move in the stock market, recession or no recession, is going to be up, Jim. And the reason it's going to be up is because it's going to go up because of capital flight. And because Europe's coming apart at the seams. China seems to be coming apart at the seams, but especially Europe. People in Europe, that place is a real mess. That they have negative interest rates, and Draghi is lowering interest rates even lower. That's like, you and I are both airplane buffs. And that's what you call getting behind on the power curve. And for viewers that don't know what that means is, when you start losing airspeed, and just applying power with the nose up, trying to pull out of a bad situation without a lot of airspeed, you can apply all the power you want, and you're still going to sink. In other words, you need to sink to a lower level to get your airspeed higher, and then apply the power, and then you can pull out of it. So I think Europe's in a stall right now, and what they're doing is they're just applying power, and it's not going to get out of it, and all the big money in the Europe is going to go to where it's treated best, because money is highly mobile, and it's going to come to the United States, Jim. I would, I think the next big move, I think that's going to be the big surprise of the next 5 years, or 2 to 3 years, whatever the case may be, that the U.S. stock market is going to keep going up.
We keep hearing about the desire to have a stronger U.S. dollar. President Trump is using tariffs as a trade negotiating tool. Would a weaker U.S. dollar be helpful in getting trade deals beneficial to the U.S. done?
Yeah, I think so. But, it's sure, by itself in isolation, yes. But here's what's happening, is the world wants dollars because that's the most stable currency in the world. And so they want that. That demand is there. People aren't trying to get out of the dollar yet. When people are trying to get out of the dollar is when U.S. inflation starts, going forward in a big way. And certainly QE, hasn't fueled that like they thought it might. And it QE certainly hasn't fueled any inflation in Europe. That's why Draghi has to lower rates even more. So I think the U.S. dollar is going to remain, relatively strong and could actually get stronger.
With geopolitical unrest continuing to grow and people divided by ideology, should gold and silver be higher than they are today?
Yeah, I think they should be higher. And I continue to think in the next, I said this 5 years ago, but I will say it again, that physical gold has always been the keel in my sailboat. That keeps everything, straight up and keeps things evenly going for me. But I think what's going to drive gold higher is not inflation. It's going to be distrust in the government. And we see that. I mean, how much trust do people have in U.S. governments around the world? I mean, look at Europe, look at France. And at some point, that people are just going to go, that all this disruption is going to end up in more and more social unrest, and that distress, people aren't going to trust the markets, and they're going to go to what's been the most trusted asset over the last 1,000 or 2,000 years, and that's gold, and it's going to soar. It's going to soar. We've talked about this in the past. Whether it's 5,000, 10,000, 25,000, I don't know what the end number is going to be, but it's going to be a rush into that very limited commodity to protect the purchasing power and the buying power of the money that relatively rich people have. Rich people invest in gold. Poor people don't invest in gold.
Is geopolitical unrest starting to show up in the price of oil?
I really can't comment on that. I don't know if it is or not. I'll tell you one thing: oil isn't the valuable commodity that here in the United States that it was 30 years ago. The United States, I believe, the United States is the number one oil-producing country in the world right now. I mean, it may be expensive, but at least it's available.
The prices of lithium and cobalt have declined recently. Could this be signaling slower growth for electric vehicles?
I have no opinion on that. I think what's going to signal signal the growth for electric vehicles is the new Green Deal.
Is a border wall bullish for the U.S. economy?
That's a terrific question, and I would say I would have to lean on the yes side. I would have to lean on the yes side because of this. Most of those people coming across the border are not only taking low-paying jobs, which is fine, that's okay, but more than that, they're a net negative to they're not bringing any productive power to the U.S. economy. They're an expense, Jim. Most of the people coming over, they're a mom and a couple of kids. I mean, are they going to go out and get a manufacturing job and pay taxes and buy a house? No. They're on subsidy. They're getting welfare. They're getting food stamps. They're getting subsidized housing. They're getting free medical care. And so I think stopping that would do a tremendous lot for the U.S. economy, if for no other reason to stop the outflow of money, to pay for people that can't afford to pay for themselves.
Does China's economy look like it could be headed for a deep recession or even a depression?
I have very little opinion on China. I was giving for this reason. I don't trust the numbers that come out of China. I was in Las Vegas a month ago in San Francisco, giving a seminar on how to time the real estate market. And one of the students in there was a 40-year-old Chinese guy, born in China, and I explained to him why I said, I don't trust the data coming out of China. And he goes, you're smart not to trust the data coming out of China. So, it's hard enough to get a handle on what's going to happen in the future if you've got good data. But when the data is manipulated to the degree that it could be manipulated coming out of China, it's an almost impossible task. So I don't even try to go through the exercise because I don't trust the data.
Bob, what was the biggest win you ever had in the markets?
Biggest win I ever had in the market was I bought a piece of real estate, a 5,000 square foot fixer-upper home on the beach in Solana Beach on a 1 acre site for $500,000 back in 1989. I put $100,000 in it. About my cost was $600, and 2 years later I sold it for $1.2 million. I made $600,000 on a piece of real estate in 2 years. That's a grand slam, Jimmy.
Bob, how can people find out more about your newsletter and your seminar that's coming up?
The news, anybody can find out about what I do going to my website. It's real simple to find. It's realestatetiming.com, just like the sound. And also you'll find a link on there to my seminar, which is March 30th, which is only 8 days away.
Bob, thanks a lot for chatting with us.
Okay, Jim, thank you very much. Enjoyed it, as always.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, and Robert Campbell. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, pleasant to be here.
Larry, you put out a news release just the other day. What was in it?
Yeah, we had a news release out, Jim, on the March the 20th, and it was that we'd filed 3 CIP patent applications for the lithium-ion battery recycling. And those patent applications are included in our initial patent application. So this is a real good stepping stone for the company. I mean, we're tying up every loose end that we can. And the patents were to do with the recovery of graphite and carbon from battery concentrates. When you grind them up, you're able to separate the graphite off of the battery concentrate. And the treatment of the electrolyte solution, which is a necessity because that's involved in a full battery, and so it's got to be dealt with. And the separation of aluminum from the cathode active material, which we've talked about quite a bit in the last little while. And it's although it's looks like it's somewhere between 90-95% successful in getting the cathode materials out, we can continue to work on that, throughout the time that we have it to try to get it at a higher rate. But right now is, you look at the foils and you could see that here and there, partially on the shredded pieces, there's some cathode material. So I'm just estimating that, we could be losing 5 to 10% of the cathode material in the foils, and like I say, I'm not going to say an easy situation to resolve, but it would certainly be a situation that we could resolve, and getting those recoveries up of the cathode material. Now, that's the glues that work on it. I don't know why it all doesn't come off the same way, but, there's got to be some reason for it. And we'll have to address that, once we're getting further towards commercial production, because we want to get all the cathode materials we can. And this is off the scraps. So that's a big item. And if you follow the recycling news or the battery news, you'll see that China has pretty much shifted away from lithium iron phosphate batteries. Now, those types of batteries, the phosphate's not a high-priced metal. And so consequently, it's dicey whether you could make money doing lithium phosphate batteries, because you'd have to make all your money on the lithium. It's possible we could, but we're happy to see them move into NMC, and they're using the 622. 622 just means that it's for 6 parts nickel, 2 parts cobalt, and 2 parts manganese, and that's the ratio of the materials in there. And that's what we've done all our calculations on, Jim, for our 3-ton-a-day plant. That's where the numbers come from. So because that seems to be the most popular, getting to be the most popular chemical formula out there. And I'm also reading, whereas there's not enough batteries out there to make an economic presentation for recycling at this point. But I beg to differ with that, with the scraps and with the 100,000 or so that reach the end of life a year. That there's plenty out there. It could be $1 billion business, and that would we certainly want a big piece of that. So that's where we're moving ahead on that. And but I'm really proud to say that Cometco and Norm Chow did a lot of work. I mean, he worked 24/7 to make sure that these CIP patent applications went in before the issuance of the patent, because that's the best time to have them in, and it's a lot less work that has to be done on the individual patents. And so that's a big milestone for us. We'll have more patents coming up. We're about finished to stage 1 and 2. I know that we've talked like it was completed, but we actually had only the 500 kilograms of the solution from one stage with the lithium cobalt aluminum batteries, and now we're in the stage with the NMC. And I think that's done, and I've been distracted. I've had some family emergencies this week, and so I've been a bit distracted, so I can't give you the exact date, but we should be working on the stage 3 to 5. So that's where we stand with that. I'm happy to see that we're still getting lots of queries, and people always say to me, where are you going to get your batteries from? Where are you going to get your product to recycle? And well, we get almost daily, we get requests from all over the world that they want to send us their batteries, EV batteries, other types of batteries, and everything else. We usually push those over to the Netherlands group because they can treat that and put it in an inert form where once we're up to and able to recycle their products, we can do that. But for all intents and purposes, everybody's talking about recycling at high 90s or 100% and doing that when they don't even have a solution in hand. They don't realize that our solution came from a process that we already had, which was our manganese process, which we spent millions of dollars on, and adapting that process for the other metals and what it took to get a patentable solution has cost millions. We probably spent $10 million on this recycling route, counting the manganese. So, it's not cheap, it's tedious, and there's a lot of work, and there's a lot of repetitive stuff, and you have to go back and redo some things, and it just goes on and on and on. We've done thousands, between the two of them, we've done thousands of bench scale tests. And that's what gave us a lever up. And I'm certainly not complaining about that, because we've tied up that metallurgical solution, and that total metallurgical solution we have, if anybody was to try to use that, that would be patent infringement, and we'd certainly go after them. And, so we try to keep our eye on anything that's happening out there, because our patent was published last July. And, I was just telling the group in here that when you tried to get on the site where it was published, it was a lineup to wait, and it was slow, and that was because there were dozens, if not hundreds, of companies that were going in there and probably copying off that solution or reading that solution on the site, the patent application. And so it would not surprise me if some people were not trying to build a plant that used our solution. But like I say, we've got the WIPO patent application, which protects us in 152 countries. And we, will very soon have the patent number. We've been assured that that the patent is approved. So, what more can I say? I think the company's in fantastic position. Fantastic position. The more they talk about recycling, even though the claims may be a little boisterous, it still brings eyeballs to that sector, and I think that's going to catch on, for AMY, sooner than later. So that's short today, because I've actually been out of the office a lot. I've had to go out. I've had a family emergency, so it's not like I've been here full time. And I wish everybody a great weekend.
Larry, where are you traded, and how can people get more information about American Manganese?
We're traded on the Venture Exchange, Toronto Venture Exchange, under the symbol AMY. We're traded in the U.S. under the symbol AYZF. We're traded in Frankfurt under the symbol 2AM. You can get all the information you need by visiting our website at AmericanManganeseInc.com, or you can phone the office here at 778-574-4444, or send me an email and at LREAUGH@AMYMN.com.
Larry, thanks for the update.
Thanks, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on March 22nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.